U.S. natural gas futures fell for a second straight session on Tuesday, pressured by moderating weather forecasts, rising domestic production, and weakening LNG export demand. It seems the bulls suspect that something bad is looming as they remained hesitant to trigger any rebound today. Traders reduced risk exposure after cooler trends emerged in weather models. Much of the southern two-thirds of the country remains hot with highs in the 90s to low 100s, but updated weather models showed a net loss of 5 cooling degree days over the weekend. Temperatures in the Northeast and Midwest are now expected to moderate from late July into early August, with analysts projecting an active storm track that could further suppress cooling demand between July 31st and August 4th. Another factor weighing on prices is the continued weakness in LNG exports. LNG net flows on Monday averaged 14.9 billion cubic feet per day, down 4.9% from the previous week. This decline coincides with signs of stronger supply. Dry gas production started the week at 107.4 billion cubic feet per day, up 4.8% year-on-year, while rig activity reached a 17-month high of 117, according to Baker Hughes. Meanwhile, European gas futures fell to €33, the lowest in more than 2 weeks, as strong supply and relaxed storage rules help contain market pressures. Despite extended maintenance at Norway's massive Troll field now expected to last through Thursday with reduced capacity, pipeline flows remain stable. LNG imports into the EU continue to run above seasonal averages, supporting inventory builds ahead of winter. EU storage levels now stand above 65% compared to 83% at this time last year. To aid restocking, the European Parliament approved more flexible storage targets, allowing countries until December to reach 90% capacity instead of the previous September deadline. Technically, support is anchored at $3.15, the low from July 9, while near-term resistance sits at the $3.40 pivot. Stronger resistance is seen higher up near the 50-day moving average around $3.50. A drop below $3.15 could spark heavier selling, particularly if weather forecasts stay cooler and production keeps rising. Without a shift to hotter weather patterns or a notable rebound in export demand, the risk of further declines remains as August approaches. Still, I expect the bulls won't back down easily, so a modest rebound remains possible, particularly if heat forecasts pick up again in the next few days. Please like, subscribe, and comment to support the channel. See you in the next one.